And in this, I will probably be speaking for many African economies. It's an economy that has huge structural deformities. You know, in our country, if you ask me to reduce the economic problems of Nigeria to one word, I would say linkages, externalities, value chains. This is a country that produces crude oil and imports refined petroleum products. The highest export of the UK to Nigeria is refined petroleum products. We have a large cotton belt. We import textiles from China. We produce tomato locally. Nigeria is the world's biggest importer of tomato paste. We are the world's #1 producer of cassava. We import cassava starch. We don't produce ethanol. We've got iron ore, iron and steel. We don't produce fat sheets. We've got huge gas reserves. We don't have power. We've got hides and skin. You know what we do with our cattle? They end up in the pot. No leather industry. We import leather industry. We have this delicacy in Nigeria called pomo. which in the textiles, which in the leather goods industries in Italy and Spain contributes to GDP, but which we very happily consume. You know, and you simply cannot continue to run an economy where you continue to import what you can produce. And you know, we export what we don't produce. Believe me. I mean, it's not just fuel. I mean, I've already told you we export fuel to the whole of West Africa, refined petroleum products. We import from the UK and export to, because all the fuel you get in Benin, in Accra, most of it comes from Nigeria. Not produced in Nigerian refineries, produced in refineries in the UK. We even had a military government in Nigeria that conducted an election in Liberia. I mean, seriously, General Abacha conducted the freest and fairest elections in Liberia when there were no elections in Nigeria. So we actually exported democracy. So it has been a great miracle of sorts. The converse, you say, the Chinese miracle. What we'd like to do is turn this miracle upside down so that we actually begin to export what we have. There's nothing wrong with exporting, but please export what you produce. And nothing wrong with importing, but import what you can't produce. In other words, why do you need to import textiles from China? I mean, today, after 30 years of Chinese growth, labor costs in China are higher than labor costs in Nigeria. With the right infrastructure, with the right technology, you can beat the Chinese at their own game. Why don't you see China as a competitor? Why don't you take away from China those industries that China took away from Europe? Why do we need to import tomato paste? I'm not saying build computers, I'm not saying build nuclear plants, I'm saying tomato paste. Cassava starch. Shoes, bags, gloves. I mean, that's not too difficult, is it? Now, the only way you can do that is to have an overarching vision for the economy that seeks to reverse this process of deindustrialization and de-development that we've been at since the 1980s. And the only way you can do that is to have this coordination between the financial system and the government. So what that told us in 2009 was that we needed to start addressing these issues. And I said to the bankers, look, I'm tired of hearing banks say, I can't lend to manufacturers because manufacturers are not profitable. The reason they're not profitable is that they don't have power. And they've got to provide their own electricity. You know, if a bank lends to a textiles company today, it's not limited to a textiles company. If you have a textiles plant in Nigeria, you've got to have your generator, so you've got to be your own power plant. You've got to provide your own security. You probably have to have your own fleet of vehicles, so you're a transport company, you're a power plant, you're a security company, and then you're a textile. Now, we said, why don't we begin to engage with the government on these key structural reforms that need to be made? Why don't we begin to engage with the government on how do you push power forward? So one of the things we did as Central Bank was to say, one of the major problems facing power companies was they couldn't get access to long-term, low-interest money. And so as part of our QE, we lent money to the banks at 1%. For on-lending to power plants at no more than 7% for a period of up to 15 years. And that would then provide finance for the power plants, who would then invest in power generation or distribution. And we did the same thing for a number of other areas. So we worked with the government on pushing forward the power reforms, but the major engagement we've had in the last 6 to 9 months was with agriculture. Agriculture is 42% of GDP, but it's primary production. And because it's primary production, it is not commercially viable. It's rain-fed. Farmers don't get access to high-yield variety of seeds. Yields on Nigerian agriculture and grains is 1.8 metric tons per hectare, compared to a global average of 3.6, and 5 or 7 metric tons per hectare in other parts of the world. And these are things that can be fixed. It's been fixed in Southern Africa, it's been done in East Africa. It's something that can be done. It's about irrigation, it's about seeds, it's about fertilizer, it's about training, and it's about access to markets. How do you get access to markets? So we started this engagement into agriculture, where we're trying to fix commodity value chains, identify 10 commodity value chains, identify the constraints around those value chains. We're working with the ministry to fix those value chains and with the banks to provide finance for those value chains. We haven't gone far, but the result is in the last 6 to 12 months alone, we've tripled the amount of bank lending to agriculture to about 300 billion naira. Now, that is a beginning, but our hope is that by 2015, we would have moved bank lending to agriculture from less than 1% in 2009 to 7%. And that we can only do by working towards unlocking those value chains. So we've got rice, for example. You know, we import rice from Thailand, from India. Some of the rice we import is rice from grain reserves, 5 years old. You know, and we've got the capacity to produce the same quality of rice and process it and export to the whole of West Africa. It's just about policy. So what has changed in terms of strategic engagement with the banking industry was to recognize that the banking system can no longer be a silo. You know, the reason the financial system got into this incestuous relationship where deposits were being used to lend to the stock market was because there was no connection between the banks and government. So we opened up that space and we started telling the government, this is what you need to do if you want banks to lend to this industry. So that is going on. I think we've made so much progress now. With Lagos State, we're going to throw, there's a lot of money in aquaculture. We're setting up tomato processing plants and canning plants. There's a whole initiative going on rice processing mills. And hopefully in the next year or two, we will see that change. And that is going to be the long-term solution to this problem of bank assets being tied up to the financial system. We've got to have real structural adjustment policy. And the subsidy removal is part of it. Stop subsidizing consumption. Why subsidize the importation of petroleum products? Why not subsidize the construction of refineries? So again, just to clarify, I don't have any ideological opposition to subsidies. The United States subsidizes its cotton farmers. And the reason the Malian farmer cannot export cotton to America